All right, good morning, everyone, and thank you for joining us for our webinar on crop insurance, excuse me, 101, what FLCs need to know. Today's webinar is brought to you by and sponsored by Relation Pan American. So we want to give thanks not only for this particular webinar, but also Relation Pan American's support throughout the years for the California Farm Labor Contractor Association, as well as our industry as a whole. So thank you so much. This morning, we are with Greg Merrill, who is the Executive Vice President and Director of Crop Insurance Services for Pan American. So the perfect person to have for this webinar. He's based out of Fresno and has spent his entire career providing insurance solutions to his agribusiness clients. He holds a bachelor's degree in business administration and a master's from the University of Santa Clarita, and holds 2 professional designations, both as a certified insurance counselor and agribusiness and farm insurance specialist. His areas of expertise include workers' comp, commercial package, captive programs, and crop insurance. So with that, I'd like to stop sharing and invite Greg to come up and share his presentation and all his excellent knowledge with us. Throughout the presentation, be sure to send in your questions using that Q&A feature. And at the end, we'll dig into all your individual questions. Greg?
Perfect. Yeah, just one quick clarification. It's a bachelor's degree from Masters University in Santa Clarita.
Oh, I'm so sorry.
Just want to make sure that was clear. But thank you for having me. I'm going to share my screen and hopefully get the correct PowerPoint up here. And Kimberly, if you could just give me the thumbs up if the screen looks good on your end.
Perfect.
Excellent. Well, welcome everybody. We're going to dive right in. We'll try to keep this concise and somewhat high level, and hopefully give you as a farm labor contractor or perhaps vineyard manager more knowledge around the federal crop insurance program and how knowledge around that for you will help you as an FLC to take care of your grower clients. Here's my contact info. That'll be at the end of the presentation as well. You could always reach out to CFLCA if you needed to reach out to us. Our disclaimer, I won't make you read that all now, but this will be recorded. So if you really wanted to read it, you can go back and refer to it. So what we'll cover, why crop insurance knowledge is important for farm labor contractors, what crop insurance is, and how the policy works and is set up. What does it cost, how claims are handled, and then we'll touch on any questions that people might have. So why is crop insurance important knowledge for farm labor contractors? Many farm labor contractors wear, I would say, multiple hats with your growers, obviously providing labor, but in the vineyard space, most specifically, there may be more elements of vineyard management. And with that potentially comes what might be deemed as professional guidance by you to your grower in terms of the growing of their crop. So that being said, as a potential professional in your field of work, knowing about crop insurance and at least being able to present that and have knowledge around that to your grower is very important. Then the recent wildfires, those obviously created a lot of buzz around crop insurance. In 2020, there were massive losses to growers. So when that takes place, that has an obvious impact on the entire wine grape industry. And crop insurance protects a grower's ability to continue farming for future years. That's why the program was put in place. And so having our growers with sustainability in terms of their financial ability to continue growing obviously keeps a sustained need for labor in the future, therefore protecting your business as a farm labor contractor. Smoke damage is really the new normal. 2017 was a massive wildfire year, followed by and outdone by 2018. 2019 was, okay, not necessarily great, but didn't rise to the level in terms of wildfires and smoke damage of 17 and 18. And then 2020 came along. And as we know, 2020 was devastating from this perspective, specifically to the wine grape industry. And crop insurance is truly the only way to protect your crop or a crop. It's a federal program, and there is no other way to protect it, not on a property policy or liability policy of any sort. Specific coverage is only found with federal crop insurance. It's important also, this knowledge coming to you right now, as the deadline for many crops, wine grapes in particular, which we'll kind of reference throughout, January 31st. And there's a handful of other crops that come up on the same date. As January 31st falls on a Sunday, the deadline is technically this year, February 1st. They give you one extra day, Monday, February 1st. So what is crop insurance? Crop insurance is set up and funded through the Farm Bill. So again, a federal program. It is regulated by the USDA. And then a branch of the USDA called the Risk Management Agency sets all the rules, the rates, the pricing. And then what the USDA does is they partner with private insurance carriers to underwrite the policies, handle claims, and ultimately administer the policies. But how do those policies get to a grower or to you? They get to you through a private insurance brokerage. That's like us, Pan American. There's many other brokerages out there who do crop insurance as well, but this is one of our specialties. So what's in it for the grower? As we mentioned earlier, financial security, protecting against yield losses due to weather and wildlife. This gives a grower, hopefully, an ability to continue operating after a disaster. With a large financial loss, they may not be able to continue on in future seasons. Crop insurance is also important for growers to secure ag funding or financing. And then crop insurance, just like any other insurance expense, is an expense and a write-off from a tax perspective. So there's a common acronyms that I'm going to mention, and I'll try to spell them out and not confuse people with a bunch of acronyms throughout this presentation. But you may hear me say MPCI, which stands for Multi-Peril Crop Insurance. That's the name of the policy. And this is insurance for multiple natural perils, adverse weather, earthquake, wildfire, etc. You can see there on the screen. What I describe to my growers is if you could picture your ideal growing season and everything just goes right, the temperature is right, the precipitation is right, the timing is right, everything's going good. If at any point during 2021, the growing season deviates from that perfect growing season that you may have in your mind, then you do have a potential cause of loss for crop insurance, as long as it's not a man-made damage, as an example. So anything naturally occurring that takes place. APH is actual production history. So this policy is based off of a grower's actual production. What we do, and it maxes out at 10 years, is we track the grower's tonnage year after year after year after year, and ultimately arrive at an average and say, okay, well, this grower has 5 tons to the acre of Cabernet, or this grower has 8 tons to the acre of Chardonnay, and the policy is ultimately derived and built off of that production. So this is ensuring a tonnage loss of tonnage, or in other crops like almonds or walnuts, it's in pounds. The unit of measure is specific to the crop. Here, we're using an example of grapes because it's very relevant, but just know you're protecting your production, you're protecting your tonnage in this case. It's not protecting a specific revenue with a multi-peril policy. Actual production history for grapes, coverages by variety and by county. This goes the same kind of for other crops as well. If you select coverage and you have a ranch in one county, one in another county, you can select different coverages by county. For grapes, they must be in their 4th growing season after being planted, or third growing season after being grafted. And so you count the year of insurability. And what I mean by that is you count backwards. So 21, 20, 19, 18. So if the grapes were planted in 2018, they'd be insurable. If they were grafted in 2019, going into the 2021 season, they would be insurable. Deadline to apply is January 31st. And insurance for grapes in particular, and again, I'm using grapes as an example. All other crops have similar dates, but if there was specific questions, perhaps to another crop like almonds or walnuts or field crops or what have you, I could answer those for you on more of a one-on-one direct basis. But the policy starts and then ultimately does have an end after harvest, destruction, or abandonment of the crop, or you can't have a cause of loss in the case of grapes that takes place after November 10th each year. So cause of loss or damage needs to take place before that time. Coverage options. So, and this is going to go for all crops, but growers can select to insure a percentage of their approved yield. And those coverage levels for grapes in particular range from 50% up to 85%, and those are in 5% increments. For most crops, this is the case. There are some crops that are only going to go from 50% up to 75% coverage. The coverage is by entity, by county, and in the case of grapes, by variety. So if you want to select one coverage for your Cabernet, one coverage for your Chardonnay, you can do so. 50% for one, 75% coverage for the other. And what we do is we do track and get an approved yield for each unit, or in this case, kind of each variety is a good way to think about it. The policy establishes what's called a guarantee, and the guarantee is the tonnage for grapes, pounds for almonds or walnuts, that a grower will receive payment for, either through the production and sale of the crop, right? So either you as a grower or your grower is going to sell the crop and make revenue based off of that, or the policy is going to cover the crop and ultimately pay for the crop based on your coverage level. So a little example to kind of start making this make sense. Your approved yield times your coverage level equals your policy guarantee. So example would be 4 tons per acre. If the grower had a 75% coverage, then the policy is going to guarantee 3 tons per acre. And then say there's 10 acres, 3 times 10, that'd be 30 tons guaranteed. So establishing the approved yield. The approved yield is based on the average of up to 10 years of production history. And any policy options that may apply to the yield, and I get a common question, and that is, well, last year, 2020, was a big loss year, and my yield was ultimately 0 because the smoke damage was so bad that my grapes were not even, were not usable. They were rejected by the winery, and so I was out of luck. What happens for that year when I'm evaluating my production history? What happens is the policy will plug into that loss year 60% of the county's average yield and ultimately try to buffer your production history to come up with an average. So as you can kind of think about it, for the last 10 years, your yield's moving right along, big loss year. Rather than having that go into your average, 60% of the county average goes in and then moves right along again, right? So that's how they help the average when you have a big loss. And in addition to that, I keep saying, you know, we track 10 years of production history, but the policy really only requires, in order to calculate your approved yield or your average, 4 years. So what if you don't have 4 years? If you have less than 4 years of your actual production history, then what the policy will do is in that chart below, or those bullet points below, that if you have 1 year of actual production, then the policy adds in 3 additional years at 80% of the county average tonnage for that crop. and ultimately make an average off of that. If you have 2 years of actual, they'll add in 2 years of the county average, or sorry, 90% of the county average, and then they'll average that to arrive at your approved yield. If you have 3 years of actual production, they just add in 1 extra tail year of 100% of the county average to get that average. And if obviously the minute you have 4 years of actual production history, that just becomes your true average, and then up to 10 years, and then the 11th year drops off at a certain point. So in crop insurance, you'll hear people reference units. Specific to grapes, most often a unit is just going to be a varietal, right? So your Cabernet is 1 unit, your Chardonnay is another unit. But units can also be broken out by vineyard location and potentially even farming practice, like irrigated or non-irrigated, or conventional farming practices versus organic farming practices. And I'll kind of gloss over this just a little bit, but just to point out how coverage can be established with what's called basic units or optional units. So a basic unit is all insured acres of the same variety that share an insurance guarantee. It's basically contiguous vineyards in this case, and claims are assessed and paid specific to that one basic unit. It doesn't matter if there's a vineyard on one side of the county, vineyard on the other side of the county. If it's a basic unit and those are the same varietal, at the time of claim, and this is specific to catastrophic insurance, which will make sense in a little bit. I'll touch on what that is. They're going to lump all that together into one basic unit, even if they're separate vineyards. What's called optional units is when the insurance guarantee is specific to a vineyard location. So same example, you got a vineyard on one side of the county, vineyard on the other side of the county. They're both the same variety, but once you've gone above catastrophic coverage, you can break that out into what's called optional units, so that even though they're on the same policy, your vineyard over here on this side of the county is going to stand alone for coverage. Your vineyard over here on this side of the county is going to stand alone for coverage. And really, it's a great way to make sure that the coverage is tailored specific to maybe those microclimates that might be in play, where one vineyard might be at a low spot that might get really cold, or orchard might be in a similar spot. But you have another same variety, same crop in another part of the county that's really in a great growing spot, and you don't see as much damage there. Optional units allow you to tailor that specifically to each location, because claims are ultimately assessed and paid by those broken out units. Here's just a little example of one big contiguous property. You can see here the Zinfandel, because all of this acreage is owned acreage and is contiguous, or it's all touching, is not separated by non-owned land. The Zinfandel here is all going to be assessed as one unit, unit 0001, 001, and down here 001. These cannot be broken out into separate units. In the case of the Cabernet, you see unit 002, Chardonnay 004, and the Malbec 003. Sorry, got a phone call coming in. I'll turn down the ringer there. And so in this case here, there are not any optional units that are going to be applied for. It's just all basic units. It's one contiguous property. Now, if you had a non-contiguous property, you can see here there's a ranch up here, a ranch down here. What's that going to do? And this is where a grower may want to consider what's called optional units. Here's kind of a zooming in on those separate units or separate ranches. And you can see here, those same Zinfandel acres at this ranch are going to be unit 0001-0001. But at the other ranch, they're going to be unit 0001-0002. So what that unit numbering does is it says that those are separate ranches. Those are separate optional units. So at the time of claim, the ranch over here on the left side of your screen, maybe it has a major disaster and the crop is lost there, but the ranch on the right side of your screen maybe had a great crop but did not experience the same issues that the other ranch did. If this was a big basic unit, all that production would be lumped together, and potentially the good production from this ranch on the right could kick the ranch on the left out of a claim situation. So that's why when you have these separate ranches, you want to break them out as optional units so that you could get a loss paid on one ranch, and if the other ranch had great production, then it's great production and you probably sold it and made good money on it. So it's important to know that when there's various ranches different and they're separated by what we call non-contiguous land or non-owned land, you can break them out into optional units. It can't just be a little road, or it can't be just say that they're kind of catty corner to each other at an intersection. It seems like they're not touching. They really do need to have a space between them of someone else's land that separates them before you can break them out. So let's talk really quickly about how we establish your production history. The font here is a little bit small, but this is giving you an example of some Cabernet. And again, this could be any crop. This could be almonds, this could be walnuts. And here we're pointing out a optional unit situation where you have unit 0001-0001 and you have unit 0001-0002. Both Cabernet in the same county, but they are just separate from each other. 45.3 acres, 45.9 acres. You see here, there's a total of 10 years of production history. Total production, in this case with grapes, it's tonnage, going all the way back to 2010. Here you have the acreage, and the acreage may vary year to year based on replants. Some acreage is pulled out, some acreage is coming into production. And then ultimately you see the yield here, 5.8 tons to the acre, 6.8, and all the way back. And ultimately, the tonnage is going to arrive at an approved yield here of 6.5 tons to the acre. But on this ranch, the tonnage approved yield is 8.4 tons to the acre. And that's based off of this production history. So production history, it's for all acres in the unit. And as we zoom in a little bit to it here, you'll notice the carriers put in red, and they put a little L next to the year, a year where you had a claim. And what you'll see, it's highlighted on the database or this kind of spreadsheet that shows all the production history, but you'll see that here, the yield for that year was 2 tons to the acre. Well, you remember when we talked earlier, when you have a big loss year, if your loss yield fell below 60% of the county average, then they're going to plug in 60% of the county average for that year. So instead of averaging a straight down this line to arrive at an approved yield, they will take and they'll average 10, 8.5, 2.82, 10.5, 5.4, 2.82, 11.1, 8.3, 8.6, 6.3 on down that line. They will exclude those red years and they'll plug in these county yields in order to help keep your averages up. And a simple average from this production history here would yield an average yield of 7.3. But when you factor in what we call the yield adjustment for those 2 years, you'll realize the policy is going to get based off of 7.4 tons to the acre here in the case of grapes. And that's because of that yield substitution for those lost years. So trying to give you an idea of the overall how the policy is built. It's built off of your production history. You can separate vineyards or ranches or orchards based on their geographic location. You want to separate those out if you can in order to get the coverage tailored to that location. But now I want to move over kind of to what does crop insurance cost? So premium is established by all the particulars about a crop, the specific crop, The variety, in the case of grapes, Cabernet, Chardonnay, Malbec, Zinfandel, go through the whole list of varieties. They all have varying costs associated with them. Your approved yield, if you have a really high approved yield, maybe in the case of grapes, it's 10 tons to the acre versus somebody with 5 tons to the acre. Well, you're going to be paying more if there's more tonnage to be covered. If there's ultimately more liability, obviously your premium is going to be higher as a result. The crush district, that's in the case of grapes, it varies. The crush district 4, which is Napa, may be different than one of the crush districts perhaps in the Fresno area or Lodi area, because obviously Napa is meant to be or believed to be the more premier wine grape location, and the values or the prices of that commodity are higher in that location. And that points to the established price per ton. Napa County price per ton for Cabernet for 2021 is $7,070 a ton. You may go over to the Valley and that same varietal, it may be $2,000 a ton or something like that. And that established price per ton is established by the USDA. So that $7,070, as I mentioned, for Cabernet in Napa County, or your contract price or a grower's contract price with the winery. Wine grapes allow you to insure up to 2 times the federal price in order to make the coverage more reflective of what you're receiving or your grower is receiving for their crop. So it's an important knowledge here for a labor contractor to know if you're working in, and it doesn't just have to be specific to wine grapes, but knowledge around how is this crop covered, at what value, at what level, and being able to provide input on that to a grower or as a grower is very important. And that points, in the case of wine grapes, to winery contracts. So premium is established, but there's something really interesting about this insurance policy. And I'm sure we all wish that we had this on all of our other insurance policies, and that's a federal subsidy. In the case of crop insurance, the federal government is ultimately paying a portion of the premium for you. And if you look down at the bottom, well, actually, before we get to that little chart on the bottom, I want to touch really quickly on what's called catastrophic coverage. Catastrophic coverage allows you to protect 50% of your average crop of your production. But the policy, if you're in a claim situation, is only going to pay out at 55% of the federal price for the commodity or for grapes tonnage. And I'll just use an easy number. If you were getting $1,000 a ton for your grapes, the catastrophic policy, if you were in a claim situation, is only going to pay you 55% or $550 per lost ton. So you can see it has a 50% coverage level, which is the lowest coverage level. But also, if you're in a claim situation, they pay you 55% of the price per ton, which is a pretty low price as well. So it's kind of bottom of the barrel coverage. What you really want to consider is potentially some of the buy-up levels of coverage. And that difference allows you to go from 50% all the way up to 85% coverage. But at all of the buy-up coverage levels, essentially the best option is to select 100% price election. So that same example of if you're getting $1,000 a ton on the federal policy for your grapes in, say, Lodi or where have you, the policy doesn't reduce that down to 55% or $550. It keeps it at that $1,000 a ton. So you get the full price, and you get to select a coverage level 50, 55, 60, all the way up to 85%. The chart down at the bottom shows each coverage level across the top that's available and the premium subsidy for each one. So the premium subsidy is the cost the feds are paying on your behalf or on your grower's behalf. So as the coverage level goes up, you see that premium subsidy comes down. And really, if you're talking to your grower or as a grower yourself, the sweet spots for coverage, in my opinion, in terms of value, is really right here at the 60% coverage level, because you're getting a 64% premium subsidy. You're getting a decent coverage level. You're protecting 60% of your crop. And you'll see this premium drops off in a tier right after 60%. So it drops off in this tier. If you wanted to say, hey, I want a little more than just the best value coverage, I want to manage my risk a little more, or I want to recommend to my grower that they manage their risk better. And again, this goes for any crop, not just grapes. You may recommend the 70% coverage level because you're getting a better coverage level. You're protecting 70% of your average crop, and you're getting 59% premium subsidy. Beyond that, you'll see there's no more tiers. There's no more, sets of subsidies. It just drops to 55, 48, and then boom, off a cliff to 38% subsidy. So really the two kind of best value coverages, value, I'd say 60. And then if there's some more premium dollars to spend looking for better coverage, 70% is where I'd be looking. Here's an example of a quote. We'll just kind of walk through this. I'm using, again, grapes. We had to pick one crop to stick with, so it didn't get too confusing, but this will apply across many crops. Here's the coverage levels, 50 all the way down to 85 on the far left side of your screen. The price election here, this grower used contract pricing for their Cabernet, and they're getting $9,000 a ton. This is a Napa grower. Their average yield in the middle here, and hopefully you guys can see my little mouse on the screen, is 3.3 tons to the acre. Total acres of 80 acres. So when you do this math and you take 3.3 tons times the coverage level, 50%, the guarantee per acre, this policy says we're going to guarantee you 1.7 tons to the acre. Multiply that times 80 acres. The policy here at the 50% coverage level says this policy is going to guarantee this grower 132 tons for 2021. As soon as the grower falls down below 132 tons, if this is the coverage level they selected, let me go back. If they selected the 50% coverage level, the minute they fall below 132 tons, the policy pays you to get back to this number. So the hypothetical would be if the grower only harvested, say, 100 tons of good fruit, that would be 32 tons lost, because you're going to get back to 132 tons, times the price election, $9,000, equals, in that case, the grower would receive $288,000 in terms of a crop insurance payment. So you don't have to have a total loss in order for crop insurance to kick in and pay. It's the minute you fall below the total guarantee. This next section here is just broken out into total liability. If you did have a total loss and say you're at the 70% coverage level, this policy would pay out essentially $1.6 million, 1.663. So we said we're talking about how much does it cost, right? How much does the policy cost? This is where it gets a little confusing because you see a bunch of numbers here: paid per acre, premium total, admin fees, and then you see base premium. What are all of these things? What I would tell you is, first, ignore base premium. We'll come to that in a second, and focus in just on this premium total. If you were at, say, the 60% coverage level, this policy is going to cost $12,825 for $1.425 million in total coverage. There's a $30 federal admin fee. But what is the real true cost of this policy? The real true cost of this policy is $35,626 at the 60% coverage level. So the feds are paying the difference for you between the 35,000 and the 12,000 number. That's where the subsidy comes in. But you as a grower, or your grower, is getting the benefit of a policy that costs $35,000. So all in all, in terms of the premium and the pricing, you can see crop insurance with the subsidy that kicks in is very advantageous to you and to your grower. If your grower does not currently have crop insurance, it's something that you should really be recommending that they look into, again, because if they do have protection, that means that they're going to be more sustainable for future years, be able to continue growing, and obviously be able to continue to bring you in as a labor contractor to continue providing the services that you do for their ranch. So how are claims handled? We're going to go sort of quick here in order to get through things and maybe answer some questions. But one thing I want to mention to you as a farm labor contractor is you're in the field, you're seeing the crop regularly. I'm sure your grower is too, but as soon as there's some damage that is seen, or you're out and you say a late freeze comes through and the late parts of April, if it's wine grapes, or maybe there's a big wind event when almond trees are in bloom, and you know that that's going to potentially have a damaging effect on the crop. Best thing you can do as a farm labor contractor is make sure your grower's aware of that, and also be able to let them know if you have crop insurance, or hopefully they do, to submit a potential crop insurance claim right away. When someone submits a claim, not like your auto insurance or workers' comp or health insurance or different things, when you submit a claim in crop insurance, it doesn't hurt you for future years. You always want to just at least put the notice in that you had potential for a claim. A lot of people think insurance and they think, oh no, I only want to put in a claim if I really, really have to, if it's a big deal, or if I'm sure of it. In the case of crop insurance, if you just have a thought that, well, those temperatures are pretty cold last night, we may have some damage when the crop starts to mature, we better let our crop insurance agent know about that. So the claims adjuster works with the grower in order to assess and process the claim. Here's where agents are essentially prohibited by the federal or by the USDA to get involved in the claims process. We can't be out there with the grower or with you looking and inspecting the crop, to put it plainly. We can obviously keep the claim moving in terms of, if you can't get a hold of the adjuster, we can try to get them in touch with you and vice versa, but we can't get overly involved in the actual claims process with crop insurance. Another thing to note, as you as a farm labor contractor are potentially harvesting those crops when the time comes, is making sure that if there's optional units, again, that's where you had a vineyard over here and a vineyard over there, and they stood alone for coverage, and maybe it's Zinfandel and it's Zinfandel. If you commingle or you bring together that tonnage, it could cause a problem in terms of a crop insurance claim. If you have optional units where the ranch over here, you need to keep that tonnage or production separate. So smoke claims. This was a big deal in 2020. Some things you need to know, and this here is very specific to wine grapes because that's where the smoke damage was most relevant. So each variety must be tested for glycol and 4-methylglycol prior to harvest. And let me correct myself just a bit. A sample must be taken in the field before harvest. That testing and those lab results, those don't necessarily need to be back in the grower's hand or in your hand before harvest, but you have to have at least documented that you've taken the sample. Typically that's 200 to 300 berries that's required by the lab, and it's been sent in to a third-party lab, accredited lab, or a credible source, which may be like a winery lab. And all claims, you want to just continue in communication, working closely with your claims adjuster. So important thing here, keeping in mind, when it comes to smoke, if there's smoke in the air, a wildfire nearby, is get that crop sample and sent to a lab before harvest. So here's a policy example, shifting to Sonoma County with some Chardonnay, 80 acres, over 10 years. It has an average yield of 5 tons to the acre. And the price per ton, this grower selected their contract price, and they're getting $2,500 a ton. They're at the 75% buy-up coverage level. So you take that 5% tons per acre, that was their average, times 75% coverage equals 3.75 tons per acre guaranteed. Take that 3.75 times the total of 80 acres, you're getting 300 total tons guaranteed. Premium for this policy, remember there's that base premium, then the subsidy applies, and then there's your grower premium. So this premium policy, or this policy, would cost almost $29,000, but the grower's premium is only $13,000. Another thing to point out here, insurance, typically you feel like you have to pay up front. In the case of crop insurance, you're actually billed and the premium is due by the end of September. And we point to that because the feds, in theory, think that's when growers are hopefully receiving money for their crop, so they're able to potentially pay that bill easier than at the very beginning of the year, where they may be spending a lot on pruning and costs to prep for the year to grow the crop. They may not have the money set aside to pay for their insurance at the very beginning. So you actually pay near the end of the policy. So what standard yield loss example, given that grower we just talked about, grower calls the agent, submits a claim, adjuster and the grower connect, and they do an inspection prior to harvest. The grower actually harvests a crop, but there was only 200 total tons that were quality enough to be delivered to the marketplace. So what you would do, if you recall, there were 300 tons guaranteed on this grower's policy of Chardonnay, minus the 200 tons that they harvested or produced, equals 100-ton loss times $2,500 price per ton, equals, in this case, a $250,000 claim payment. Pretty easy math, pretty straightforward. Smoke exposure, however, gets complicated. Grower calls the agent, submits a claim, adjuster and grower connect, they do an inspection, the claim is opened, etc. The grower pre-harvest does samples, sends it into the lab, and it shows elevated levels of 4-methylglycol and or glycol. The results from testing do not need to come back prior to harvest, but just remember you have to send them in. So the grower still continues on, begins to harvest the crop. 80 tons are delivered to the winery and they are actually accepted, but they're accepted at a reduced value of $800 per ton. From that point, 350 tons are just left in the field and they're appraised on the vine that yes, there's 350 tons left out there, but they're not harvested. This is where it's going to get a little complicated. What the policy does is it does what's called a quality adjustment factor. And when quality is impacted, the grower has actually produced a crop, so the tonnage is there, but there's a monetary loss or a quality loss due to a covered peril. So the claims process still adjusts if you got $800 a ton for your grapes, but you should have gotten $2,500 a ton for your grapes. That's a dollar difference. The policy still adjusts back using a ratio of 800 versus 2,500 to convert that back into tonnage. Because remember, this policy can only pay on lost tonnage. So the quality adjustment factor is applied in these cases. Quality claims adjuster determines the value of those damaged grapes. Sold or unsold was $800. Claims adjuster determines the value of undamaged grapes using the lesser of the market price, the insurance price, or the contract price. So what that says is you kind of take what you did get paid, $800 a ton, divided by what you should have gotten paid, in this case, the lesser of these three numbers. So they're going to use the insurance price on the policy, $2,170, to arrive at a quality adjustment factor. So 800 divided by 2,170 equals 36,000, or sorry, 36%, 36.866%. Now, if that percentage is greater than 75%, then they will not adjust this on a quality loss. It has to fall below 75%. This number right here of what you did get paid divided by what you should have gotten paid has to be below 75%. So the 36.866% quality adjustment factor is then applied to the tonnage. There were 80 tons harvested, 350 tons were appraised or hanging on the vine still. That's a total of 430 tons. So you take that quality adjustment factor times 430 equals 158.5 tons to be used, and that count towards the claim. Now, one thing to note here, if the grapes that were on the vine, so to speak, and after testing and whatnot, were just completely rejected due to outright smoke damage, they have zero value, nothing to be used, then there is no quality adjustment factor. It's just zero loss. You have a total loss, and 0 tons are counted towards the policy production. What we're talking about here is that there is some value to the grapes. They could be sold at $800, or you did receive $800, a reduced price per ton. So qualifying for a claim payment, grower must be under their insurance guarantee. And if the grapes were left unharvested, then based on your crush district, you're going to receive a deduction per ton to your claim payment. Now this only applies to tons where there's unharvested acreage after the quality adjustment factor is applied. So I'll kind of breeze through this because this gets pretty technical, but harvested grapes after the quality adjustment factor and acreage guarantee are applied is a total of 29.5 tons. Remember there was, if I remember right, 80 tons that we had that were actually harvested. Let's just take a quick look back. Yep, 80 tons were harvested. So times that quality adjustment factor results in 29.5 tons, times the price, that's one component of the claim payment, $73,000, $73,750. Now on the unharvested side, they're going to deduct, and this is Sonoma County, so they're going to deduct $200 per ton. How's that work out? They take that price you were going to get paid, $2,500 a ton, minus 200. Now on the unharvested grapes, you're going to only receive $2,300 a ton. And if you recall, there were 350 tons here still out there on the vine that were damaged and ultimately part of this quality loss adjustment. So you'd take that quality adjustment factor times 350 tons equals 129 tons, now times $2,300 equals $296,700. This claim payment would be these two numbers added together, $370,450. Again, if the smoke damage was such that there's a complete rejection, there's no good production, the calculation would be very simple. The 300 tons were totally lost minus 0 tons produced, so 300 tons loss times $2,300 because you didn't harvest. It was just leave it out there, maybe prune it off when the time comes, but it's not going to be a true harvest. You're going to get $2,300 a ton, or $690,000 in this case. Or if you did harvest it, but ultimately the winery rejected it, you get your $2,500 a ton times the 300 tons equals $750,000, or the full policy guarantee. So reminder, I know that was a lot of detail, but why did we cover all of this detail? There's a lot to learn here in terms of how the policy works, how claims are paid. But remember, FLCs and vineyard managers, especially, and some vineyard managers have the FLC license, wear multiple hats. And again, this could apply towards almonds or walnuts or other commodities, citrus, whatever it may be. Knowing more about crop insurance, you as a professional in your field will help you with your grower will help you and your grower to be more sustainable financially for the long haul. And we're here also because those recent wildfires really put this on the forefront. Not only that, but the deadline, and this is the annual deadline for most crops, citrus as an example, is actually November 20th for the crop year. So we're past that. Avocados are November 30th. Almonds are December 31st. Walnuts, grapes, and various other crops. There's a lot of crops that come up on January 31st. So we're right in the middle of crop insurance season, and that's why this is really on our minds. So with that, Kimberly, if there's any specific questions, we can touch on those now. Be glad to answer them if we can.
Thanks, Greg. It looks like we haven't had any questions submitted yet, hopefully because that was very thorough rather than overwhelming.
Exactly. Hopefully nobody's asleep either. No, and if none come through, what I would just encourage folks to do, because I know we touched on grapes very specifically, but just know a lot of these same principles apply across for many different crops, though each crop does have kind of its nuances. If you as a labor contractor are wanting to know more, please reach out to us. Our main focus in the crop insurance side of the world is not to come at you and sell you an insurance policy. We want to educate. We want to make sure that our growers, our farm labor contractors understand the program, at the very highest levels, so that the best decisions can be made. And then ultimately, if we can handle the policy for you, that'd be fantastic. So anybody can reach out to us at any time.
Great. We will be sharing out this recording for anybody that came in late or missed it, as well as a copy of Greg's presentation. I know sometimes I need to go back through and look at some of those calculations for it to really sink in. But are there any other resources that you would recommend, Greg? Obviously, we have your contact information, but anything else that you would recommend people could go and review as far as deadlines or the process itself?
Yeah, so, I would connect generally, and this is what, kind of we're doing with CFLCA, but we also work pretty closely with folks like the California Association of Wine Grape Growers, even some more regional associations. We also work with folks like Blue Diamond and Diamond Walnuts and so on, in order to get this information to growers and to labor contractors. So your association, in the case here, CFLCA, a great place to start when you have questions like this, to look for resources and so on, to gain more knowledge around these topics. So regional, local, statewide associations, in my view, be the place to go for people to be pointed in the right direction.
Okay, as far as the deadlines go that you had mentioned, the January 31st, is that the deadline to have everything completed, or is that the deadline to begin the process? Where does that fall? And do those deadlines change every year?
So great question. So in general, the deadlines do not change, just only when, in the case of a deadline falling on a weekend, they usually give you till that next Monday in order to meet the deadline. So January 31st, as an example, is the deadline to sign up for coverage. So what you as a grower or a grower needs to do is have selected their coverage level, provided their general information, name, address, phone number, tax ID number, crop information, and just really the basic information in order to sign up for coverage for the year. Technically, that's all you would need to do, because there's two other dates later in the year that you can abide by in order to report your production and then your acreage. And it's 45 days after signing up for the policy, you have to have reported your production for the prior year. So typically it's around March 15th. And then the next deadline would be May 15th in order to report your final acreage. And what happens there is, say you're going to rip an orchard out or a vineyard out between that time when you signed up and May 15th, you're not stuck with a policy say you had 100 acres and you pulled out 50. By May 15th, you can submit a revised acreage report that says, hey, we just have 50 acres now. We don't have 100. What we try to do, though, is gather all the information up front, relatively pain-free. We fill and auto-complete a lot of the forms for you, such that the signature that's taking place with the date of January 31st or prior is effectively signing up for coverage, selecting coverage levels, reporting your production, and reporting your acreage for the year. So we try to get it all done at once, but knowing if we need to adjust something by March 15th or by May 15th, we can do so.
It's definitely not something to procrastinate on and leave all till the 31st.
Yeah, correct. But I do want to point out to growers that if this was January 31st and we were hosting this call right now, if we were taking a phone call right after saying, hey, I need to get signed up for coverage, it's still possible. It's very doable. Don't wait till the last minute, but if somebody gets in a pinch, there's the ability to get it done timely.
Nice to have that flexibility.
Yeah.
All right. Well, it looks like we, excuse me, we don't have any more questions coming in, so it looks like we can let you go a little bit early. Thank you again so much, Greg, for your time, sharing your expertise. And well, it looks like Lupe might be jumping on here to join us. We'll see if he'll connect to audio. He might have a couple questions for you.
Sure thing. Yeah.
Hey, Lupe.
Morning, Kimberly. How are you?
Good. Did you have some questions for Greg here?
No, I don't.
All right. Well, then we'll just say thank you so much, Greg,
Perfect.
for your time, all your expertise here, and also, of course, for your support of CFLCA and the FLC and ag industry.
You got it. Very good.
More now than ever.
Thank you very much.
All right. Thanks so much, Greg. We'll see you next time.
Bye-bye.